Listen to me very carefully. What I'm about to tell you is not speculation, it's not theory. It's happening right now, while most of America is still asleep, and by the time the mainstream media picks this up, it'll be too late for you to position yourself accordingly. Silver just hit $125 per ounce on the Shanghai Futures Exchange. Read that number again. $125 per ounce. I'm Marcus Stone, and I've spent the last 15 years tracking precious metals markets, geopolitical supply chains, and the disconnect between paper pricing and physical reality. And what's unfolding in Asian markets right now is the single most significant price action I've seen in silver in over a decade. Before I break down exactly what this means, why it's happening, and what you need to do about it, let me be clear about something. If you're here for hype, if you're here for get-rich-quick schemes, if you're here because you want someone to validate your confirmation bias, this isn't for you. I'm building a community of serious independent thinkers who want to understand how markets actually work, not how CNBC tells you they work. If this resonates, if you want unfiltered analysis and real-time updates on what I'm tracking next, join the free community. Link in the description. Approval takes a moment because we keep out the scammers and bots. If anyone asks you for payment, block them immediately. Everything I offer is free because I'm not here to sell you courses. I'm here to share information. Now back to what's happening right now in Shanghai. We are exactly 2 hours and 17 minutes into Monday trading in Asia. Silver opened strong, and it hasn't looked back. The Shanghai Futures Exchange is showing silver at approximately 28,000 yuan, which translates to $125 per ounce at current exchange rates. Meanwhile, COMEX silver in New York closed Friday at $108. As Asian markets opened, COMEX futures started climbing toward $110, but they're still trailing Shanghai by $15 to $7 per ounce. Let me say that again because this number is critical. The Shanghai premium over COMEX just exploded to $15 to $7 per ounce. That's not a premium. That's a chasm. In a functioning global market with efficient price discovery and free flow of physical metal, a premium like that should exist for maybe minutes, maybe hours at most, before arbitrage traders close the gap. You buy on the cheaper exchange, sell on the more expensive one, pocket the difference minus shipping and insurance. Except, that's not happening. And that tells you everything you need to know about the state of the physical silver market right now. When you see a sustained premium of this magnitude between two major exchanges, you're not looking at normal market volatility. You're looking at one of three things, or more likely, all three at once. First, physical metal is not available in the quantities needed. The Shanghai premium exists because Chinese buyers cannot source sufficient silver through normal channels at COMEX prices. They're willing to pay $125 because at $108, $110, or even $115, they can't get the metal they need when they need it. This isn't about preference. This isn't about convenience. This is about availability. Second, logistics cannot keep pace with demand. Even if silver is theoretically available in New York or London, getting it to Shanghai fast enough to capture the arbitrage opportunity involves shipping, insurance, customs, storage, and time. In a market moving this fast, by the time you ship metal from a COMEX warehouse to Shanghai, the premium might have shifted, or worse, the metal you thought you could buy is no longer available. Third, strategic considerations override pure economic arbitrage. China isn't just buying silver because it's cheap or because they see an investment opportunity. They're buying because silver is a critical industrial metal with no substitute in most applications, and they're in the middle of the largest solar energy build-out in human history, the largest electric vehicle transition in the world, and a 5G infrastructure expansion that dwarfs anything happening in the West. When you need silver for strategic industrial purposes, you don't haggle over $15 per ounce. You pay what you need to pay to secure supply. Let's talk about what's been building for months while most investors were distracted by stocks, crypto, and real estate. COMEX registered silver inventories, the actual metal available for delivery against futures contracts, have been declining steadily. We're not talking about a one-month blip. We're talking about a multi-month trend of metal being withdrawn, reclassified, or delivered out of exchange warehouses. At the same time, open interest in silver futures remains elevated. That means there are more paper claims on silver than there is physical metal available to satisfy those claims if everyone decided to stand for delivery. Now, under normal circumstances, this isn't a problem. Most futures contracts are settled in cash, not physical metal. Traders are speculating on price movements, not trying to take possession of 5,000-ounce bars. But we're not in normal circumstances anymore. When Shanghai is willing to pay $125 and COMEX is trading at $110, suddenly it becomes very attractive to buy COMEX futures, stand for delivery, ship that metal to Shanghai, and capture the premium. If enough traders try to do this simultaneously, COMEX runs into a problem. They don't have enough registered inventory to satisfy delivery requests, and this is where things get interesting. The London Bullion Market Association, the other major hub for silver trading, is in a similar situation. Inventories have been flat to declining. The days when London vaults held seemingly endless supplies of physical metal are over. Meanwhile, the Shanghai Gold Exchange, which also trades silver, has seen its own inventories tighten as Chinese buyers have consistently been net accumulators of precious metals. We're watching a global supply chain fragment in real time, and the price action in Shanghai is the visible manifestation of that fragmentation. I want to address the technical side of this move because it's important to understand whether we're looking at a sustainable trend or a short-lived spike that gets reversed when New York opens. Silver blew through resistance at $105 like it wasn't even there. The relative strength index on the hourly and 4-hour charts is deep into overbought territory, which normally signals a pullback is coming. But here's what's different this time. On the weekly and monthly timeframes, silver is breaking out of a multi-year consolidation base. We've been range-bound between roughly $22 and $32 for years, with occasional spikes quickly beaten back down. The breakout above $35, then $50, then $75, and now above $100 represents a fundamental shift in market structure. The volume accompanying this move is legitimate and substantial. This isn't a low liquidity spike happening in overnight trading that gets faded when the real players show up. This is institutional level, sovereign level buying. The moving averages are all aligned bullishly. The 50-day is above the 200-day. Price is above both. We have what technical analysts call a golden cross pattern, and momentum is accelerating, not decelerating. Now, does that mean silver can't pull back? Of course not. After a move of this magnitude, a consolidation or even a sharp correction is not just possible, it's probable. But the overall trend structure suggests we're in the early innings of a major repricing, not the late stages of an exhausted rally. Let's zoom out and look at the bigger picture, because the Shanghai premium isn't happening in a vacuum. China implemented export controls on critical metals, including gallium, germanium, and rare earth elements over the past 2 years. They've made it clear that in a world of increasing geopolitical tension, strategic resources are not just commodities to be traded freely. They're tools of national power. The United States, meanwhile, is pushing hard for reshoring and friendshoring of critical supply chains. The CHIPS Act, the Inflation Reduction Act, and various executive orders are all designed to reduce American dependence on Chinese manufacturing and Chinese-controlled supply chains. Tariffs are being weaponized on both sides. Supply chains are fragmenting along geopolitical fault lines. The era of frictionless global trade in strategic materials is over. In this environment, if you're China and you need silver for your solar panels, your electronics, your EVs, your 5G infrastructure, your military applications, you don't wait around hoping COMEX will offer you a better price next week. You pay the premium. You secure the supply. You stockpile what you can while you can. The $15 to $17 Shanghai premium isn't just about supply and demand in the economic textbook sense. It's about strategic stockpiling. It's about ensuring you have what you need when you need it, regardless of what global markets are doing. And here's the part that should concern anyone still believing that COMEX and the London Bullion Market Association set the real price for silver. If Shanghai can sustain this premium, it means the physical market in the world's largest manufacturing economy and the world's largest consumer of industrial silver has decoupled from Western paper pricing. That's not a temporary dislocation. That's a structural shift in how silver gets valued globally. Here's the midpoint reveal, the insight that should reframe everything we've discussed so far. This Shanghai price action, this $120 silver, this $15 to $17 premium over COMEX, all of this is happening while Western institutional investors are largely absent from the silver market. Think about that. Hedge funds, pension funds, sovereign wealth funds, family offices outside of Asia have been underweight precious metals for years. They've been overweight tech stocks, private equity, real estate, crypto. Silver has been ignored, dismissed as a relic, a boomer investment, something your grandfather bought in the 1970s. But what happens when these institutions wake up to what's happening in Shanghai? What happens when portfolio managers see a $17 arbitrage opportunity and start buying COMEX futures? What happens when supply chain managers at major corporations realize they need to hedge their silver input costs because industrial users in China are paying $125? What happens when sovereign wealth funds decide they need strategic exposure to critical metals? If Western institutional money starts flowing into silver, not as a speculation, but as a strategic allocation or a supply hedge, we're not talking about a $15 to $17 premium anymore. We're talking about a global repricing of silver across all markets. Let me paint the scenario. Asian buyers are paying $125. COMEX is at $110. Western funds start buying futures to capture the arbitrage or to hedge strategic supply risk. COMEX registered inventories can't meet the delivery demand. Premiums on physical metal in New York and London start climbing to match Shanghai. Backwardation, where spot prices exceed futures prices, becomes persistent instead of occasional. At that point, the paper market loses its credibility as a price-setting mechanism, and we enter true price discovery based on physical availability. The futures exchanges have tools, of course. They can raise margin requirements to make it more expensive to hold positions. They can impose position limits to prevent any single entity from cornering the market. In extreme circumstances, they can halt trading or settle contracts in cash rather than physical delivery. But every time they use these tools, they erode confidence in the paper market as a legitimate pricing mechanism. Now, I know what you're thinking. Marcus, this sounds too good to be true. This sounds like hopium. This sounds like every silver rally we've seen over the past decade that got smashed back down. And you're absolutely right to think that way. That's the discipline we need. So let me give you the bear case, the reasons this Shanghai premium might not hold, the resistance we're facing, and why you should be cautious about chasing this rally at current levels. First, this could be a Shanghai-specific squeeze. If this premium is being driven by a few large Chinese buyers or a technical issue with a specific futures contract on the Shanghai exchange, it could reverse as quickly as it appeared. We've seen flash premiums before in other commodities when a particular warehouse has issues or a specific contract goes into backwardation temporarily. If the situation in Shanghai normalizes, that $17 gap could close in a matter of hours. Second, the paper markets have absorbed shocks before without breaking. COMEX has tools. They've used them before. During the silver spike in 2011, during the Hunt Brothers episode in 1980, the exchanges changed the rules mid-game. They raised margins. They imposed position limits. They did whatever was necessary to prevent a default. The concentrated short positions we can see in the commitment of traders' data. The big banks, the commercial hedgers, these players have deep pockets and regulatory connections. Don't underestimate their ability to cap a rally that threatens their positions. Third, profit-taking pressure is real. Traders who bought silver at $90 or $95 are sitting on 30% gains in a matter of weeks. The temptation to lock in those profits is enormous. If we get a wave of technical selling from traders hitting their price targets, it could stall this rally even if the fundamental supply shortage is real. Fourth, macro conditions could shift rapidly. If the Federal Reserve suddenly turns hawkish, if the dollar strengthens unexpectedly, if we get a risk-off event in global markets, a credit crisis, a geopolitical shock, a liquidity crunch, silver could get sold alongside other risk assets. We're in a fragile macro environment. Don't assume that just because the supply-demand fundamentals support higher prices, the market will cooperate. Fifth, and most importantly, full risk disclosure. Silver is volatile. If you're not prepared for a $20 swing in either direction over the course of a week, you shouldn't be in this market with significant capital. If you're over-leveraged, if you're trading on margin, if you're using money you need for rent or your kids' college tuition, this is not the time to chase a parabolic rally. The risk of a violent correction is real, and I need you to understand that before you make any decisions. Having said all that, here's why I believe the bullish case for silver, despite those risks, is stronger than it's been in years. The Shanghai premium isn't happening in isolation. Look at the convergence of factors. COMEX registered inventories have been declining for months. London vaults are seeing similar trends. Shanghai Gold Exchange premiums for gold are also elevated, not just silver. Central banks globally are buying gold at record pace, signaling distrust of fiat currencies and paper assets. Industrial demand for silver is outpacing mine supply by a widening margin every single year. Geopolitical fragmentation is making cross-border metal flows less reliable and more expensive. The solar energy transition requires massive amounts of silver, somewhere between 100 to 140 million ounces per year, just for photovoltaic panels. Electric vehicle production is in its early stages, and each EV uses significantly more silver than an internal combustion engine vehicle. AI data centers need silver for high-performance computing and efficient electrical connections. Military and defense applications are non-discretionary and don't stop because the price goes up. These aren't speculative demands. These are structural, non-negotiable uses that represent the foundation of modern industrial civilization. And here's the critical point. If COMEX tries to suppress the price while Shanghai is paying $125, the arbitrage flows will drain COMEX inventories even faster. You cannot maintain a $17 pricing disconnect for long without physical metal moving to the higher-priced market. And if COMEX doesn't have the metal to deliver, the whole paper pricing structure starts to crack. We're potentially watching the early stages of a global silver market reset. The days of COMEX and the LBMA setting the price while Asia and physical buyers just accept it might be ending. Shanghai is effectively saying, we'll pay what we need to pay. And if the West wants to play paper games, fine. But the physical metal is coming to us. For those of you holding physical silver, this is validation. The premiums you've been paying for months, the $8, $10, $12 over spot for coins and bars, those weren't dealer gouging. Those were the market trying to tell you that physical metal is worth more than paper contracts. Now, Shanghai is confirming it at the institutional and sovereign level. Your decision to hold physical wasn't paranoia, it was preparation. For active traders, the setup is both opportunity and extreme danger. The momentum is undeniable, but the risk of a sharp pullback is equally real. If you're long, know where your stops are. Know your exit strategy. Have a plan for both scenarios, continued rally and sharp reversal. If you're looking to enter, don't chase the top of a move that's already up double digits in a day. Wait for consolidation. Wait for a pullback to support levels. Discipline beats FOMO every single time. For stackers and long-term accumulators, the question is whether premiums on retail products follow Shanghai higher or whether you see a temporary dip as dealers adjust to the new price reality. My expectation is that premiums stay elevated or rise further if this price action holds. Physical availability is the constraint, not paper price. Dealers who sold inventory at $30 over spot when spot was $100 now need to replace that inventory at $110 or $125. Those costs get passed to retail buyers. For industrial users, if you use silver in manufacturing and you haven't hedged your input costs, you're now facing a serious problem. A move from $100 to $125 might seem like just 25%, but on thin margins, that can be the difference between profit and loss. This is a wake-up call to treat silver as a strategic material, not just another line item on your commodity input sheet. Let me distill this down to 3 core insights. 1. A $15 to $17 Shanghai premium over COMEX is not normal market behavior. It signals a structural supply issue, not just temporary volatility. When the world's largest consumer of industrial silver is willing to pay that much more than Western exchanges, it's telling you something fundamental about availability. 2. If this price disconnect persists for days or weeks rather than hours, it challenges the credibility of Western paper markets as the global pricing mechanism for silver. We could be witnessing a transition where physical markets in Asia set the real price, and Western futures exchanges become increasingly irrelevant for price discovery. 3. The convergence of industrial demand, geopolitical stockpiling, and draining inventories is creating a supply crisis that higher prices alone might not solve quickly. You can't bring new mines online overnight. You can't substitute other materials for silver in most applications. This isn't a problem that resolves itself in weeks or months. Here's what we still don't know, and what you need to watch closely in the coming days and weeks. Will COMEX and the LBMA acknowledge this pricing reality or try to suppress it? Watch for changes in margin requirements, position limits, or other regulatory interventions. These would signal that the exchanges are feeling pressure and trying to manage the situation. Will Western institutional money pile in or stay on the sidelines? If major funds start allocating even 1% or 2% of their portfolios to silver, the scale of capital is enormous. But institutional money is notoriously slow to move and hesitant to chase rallies. Is Shanghai's willingness to pay $125 a short-term squeeze or a permanent repricing? This is the key question. If Chinese buyers continue paying this premium for weeks, it's not a squeeze. It's the new price reality. COMEX registered inventories. If we see continued withdrawals or large delivery requests, it confirms the supply pressure is real. Physical premiums on retail products. Check what dealers are charging for silver eagles, maples, and bars. If premiums spike above the already elevated levels, it confirms the Shanghai price action is flowing through to retail markets. Price convergence or divergence. Does the gap between Shanghai and COMEX narrow as COMEX rises to meet Shanghai, or does it widen as Shanghai pulls even further ahead? Volume and open interest. High volume on rising prices with increasing open interest suggests new money is entering the market, not just existing positions being closed. Geopolitical developments. Any news about export restrictions, tariffs, or trade tensions between major economies will directly impact metal flows and pricing. We are living through a fundamental restructuring of global commodity markets. The post-World War II order, where Western financial centers set prices and the rest of the world accepted them, is fracturing. What's happening in Shanghai right now with silver is a microcosm of a larger trend. Physical reality is asserting itself over financial engineering. Strategic necessity is overriding economic optimization. National interest is trumping global efficiency. Silver isn't just a precious metal. It's not just an inflation hedge. It's a critical industrial commodity that sits at the intersection of the energy transition, the digital economy, and geopolitical competition. The battle between paper pricing and physical reality is reaching a critical inflection point. One side is going to win this battle, and my money, literally, is on physical reality. But that doesn't mean the transition will be smooth, linear, or without violent reversals along the way. Stay sharp, stay informed, do your own research, verify everything I've told you. Understand your own risk tolerance and act accordingly. If you're holding physical metal, understand why you're holding it and at what price, if ever, you'd consider taking profits. If you're trading, respect the volatility and manage your risk religiously. If you're just watching, understand that what's unfolding right now could reshape precious metals markets for the next decade. This isn't just another rally that gets smashed back down. This is different. The fundamentals are different. The geopolitical context is different. The supply-demand dynamics are different. History is unfolding in real time, and you're witnessing it. Don't let anyone tell you this doesn't matter. Don't let anyone tell you it's just speculation or hype. The market is speaking. Shanghai is speaking. Physical reality is speaking. The only question is whether you're listening. I'm Marcus Stone. This is real analysis for real people. No hype, no BS. Just the truth as I see it based on data, fundamentals, and 15 years of tracking these markets. Stay informed, stay rational, and whatever you do, don't be complacent. The silver market just sent a signal that cannot be ignored. Marcus Stone, out.